Okay, Matt Orton is with us, Chief Market Strategist at Raymond James Investment. We also have Arvind Sanger, Managing Partner, Geosphere Capital Management. Gentlemen, great to have both of you here. Appreciate it. What to even ask? It is what it is. It is all red. It is all bad. But let's try and look ahead. Matt, what's your sense? How are things going to progress from here? What should we see?
Hey, good morning, Prashant. And it's difficult to know exactly what the path is, but I think what we can say is that the current state that we're in with respect to where, Liberation Day, April 2nd tariffs came in, that's not going to be the ending point. I think what we've seen from the administration and from the rhetoric is that there's a potential that tariffs could increase depending on retaliatory measures that are taken, but tariffs can also decrease. And I think the idea of bilateral trade dealers are going to be very, very important. I think India in particular stands in a very, very attractive position. And what I've been urging clients since the start of this year has been to lean into diversification across asset classes, across geographies, across sectors and industries. And this is also not the time to be selling. This is the time to be continuing to lean into being defensive, because this too shall pass. It might take longer than we think it's going to, but there are places that we can hide in this market. And I think that's the main message to give to clients, is that this is not the time to completely liquidate, because when good days come and you miss them, that can be very, very bad for longer term returns as well. But there are places to hide. India is one of them that I like a lot. And when you look around the rest of the world, other markets like Brazil could also be interesting, as well as just your more traditional defensive sectors.
Got that. Arvind, we can, of course, take stock of the damage. And it's really bad, and all kinds of course, historical comparisons. But let's try and look ahead. Do you think, and I was saying this earlier, none of the comments from Trump himself or his top officials indicate that they want to walk back. They're not looking for an easy, quick win, at least not right now. But, these targets are moving all the time, very fluid situation. But do you think if we, over the next, say, 1 week, whatever, we get a headline saying, well, say, one country, let's take Vietnam as an example, that they're ready to reciprocate by lowering tariffs, what they've imposed, very high tariffs on Vietnam. Global markets will take that as an indication, and that'll be the start of some stabilization at least. What's your sense, Arvind?
I am skeptical if EU chooses to retaliate, which they're indicating they might do in the next 24 to 48 hours. Then what we have is the two biggest trade blocs, which would be China and EU, taking the approach that appeasing Trump has not been a path to having a stable situation in terms of tariff, because Trump always comes back, President Trump comes back and tries to recut the deal, as the North American countries have seen with USMCA in his first term, and now insisting that, that was a bad deal. So I think that the problem is that, yes, you can have, Vietnam or Afghanistan as the latest one we heard offering to lower tariffs, but I don't think that's the real problem. The problem is that if the major economies in the world, like China and EU, decide to dig in and take retaliatory action, then things might have to get a little uglier before they get better. So I don't think Vietnam is going to be enough to turn the ship around. I think it's going to be some major deal. Maybe TikTok becomes the excuse for a deal with China, but something needs to happen. But what President Trump, I don't think, gets is that the Chinese or the Europeans need a win-win. President Trump wants to believe that it's going to be a win-lose, and everybody else is going to bend the knee, as they say, to accept America's greatness. And I think that is where the problem comes in. I think things might have to get worse before they get better.
Yeah, I'll take your point, Arvind. Completely understand what you're saying, which is why I've done nothing over the weekend except just look at every single tweet, every single social media post, and it's very hard to sort of form trading opinion or positions based on that. You don't know what he's doing next. But like you said, if you just follow the nature of those comments or bites or posts, the fact that he's extended that TikTok deadline, he's saying that, oh, of course, I understand China is hurting, but, now we need to negotiate a better deal. What would the odds be, is a weird question, but what would the odds be of some sort of a walk back? because that could immediately induce a massive short covering rally or some sort of a relief rally in markets, right? Would you bet on that, Arvind?
I would not, because I don't think China is going to want to seem to be forced at so-called, like a gunpoint to make a deal. I don't think that is in China's best interest to be seen, or Xi's best interest to be seen as kowtowing to Trump and being forced by Trump to do a deal. So I think that's
Arvind. In fact, I was hinting at the other part, that Trump look at the kind of opposition and their protests in the U.S. on the streets. Almost everybody, including Bill Ackman, is now openly saying that this is not good for the economy. This is not good for stocks. It's really not good for anyone. So given the kind of pressure that's mounting, the perhaps quote-unquote rift between Musk and Trump himself, would you expect Trump to walk back? Is that a wager that you'd be willing to take, or is it too risky a bet?
too early. They're not showing signs yet of giving in. I think we need to see tweets from President Trump indicating something changed.
Okay.
All right. Hi, good morning, gentlemen, and good to see you. And it appears it's going to be a difficult day of trade. But Matt, let's come across to you. You've been quite bullish on Indian market prospects, but you're also talking about asset allocation. So what's the asset allocation strategy as of now? The global equity markets as an asset class have got sold into. What would be the exposure to fixed income, to gold, to equities? And within equities, how much of it would India get, from your capital allocation perspective? Because in the past, you've spoken about the Brazilian market as well, and you believe that as well could be decently placed. Please go ahead.
Yeah, all great points, Nigel. And I think from an asset allocation perspective, one of the most important things for investors to look at is what's their balance as well. There's no one blanket asset allocation that's going to work. I think clearly heading into this, it would have been great to be completely in fixed income and gold and not in risk assets, but that's just not reasonable. So I think it's how do you marginally lean into some of the things that are likely going to work in the near term, and how do you lean out of some of the areas of more risk within the market without hurting yourself when we should see a flip in this. And I agree with Arvind that I think we're away from actually seeing the actual bounce. I'm urging clients not to buy bounces in this market, or at least in the US, and I'll call it the global equity markets, because I do think there's going to be more tit for tat before we actually get to the end of this. But to answer your question, Nigel, I think from an asset allocation perspective, you want to be overweight in risk, in low risk assets, so treasuries. And I think you want to balance duration just because rates have come down so much. But I think it's more likely than not you are going to get rate cuts in the US, more than I would have expected, say, 1 week ago. So duration can be your friend. Gold as well, and gold miners, which sold off significantly on Friday, I think can be a tactical opportunity for investors because they're levered to gold. It's not part of the tariffs that are put in place right now. And so I think that's an area that investors can also find a little bit of protection in the overall market. When you look from a global perspective, though, like I said before, countries like Brazil, where they're a little bit more insulated, Latin America as a whole has been a little bit more insulated from the tariffs that we've seen. Brazil's also an alternative to some of the goods that could be caught in the trade war, like U.S. agriculture. During COVID and during the Ukraine war, they provided significant amount of agricultural resources. They also rich in minerals. So that's another country to keep on your radar, especially if this could be a reason for the central bank to keep on an easing path. That could provide support to equities. And the Bovespa only has about a 1% exposure to U.S. revenue. So that is also very, very advantageous. And finally, you get to India. India is also a much more domestically driven economic story. The government's in a good place. So I think the earnings growth trend can continue even during this tariff war.
All right. No, absolutely. Got that. Arvind, for India, right? You heard Matt talk about India a few times. I mean, we're not significant trading partners with the US. You said, to my response earlier, you said, well, it has to be a big country, EU or China or something, for it to be a signal that things are thawing a little bit. Smaller countries would not matter. But that aside, for India, our deficit is about $40 billion, right? We buy some $80 billion of oil anyway. We import every year. And if the aim for the US is that let's get this 40 billion, we want to wipe out deficits with all trading partners. India can very well say, well, we'll buy oil from you instead of buying it from Venezuela or the Middle East or whatever. So it can be done in that sense. You think that's the way forward? And in any case, I mean, as I said, direct trading is not that not very high. The impact, of course, is through financial markets, etc. Go on.
Yeah, no, I agree with Matt, everything he said about India. I think that India is obviously much more domestic-facing economy, and so that's less of a concern. And I think India's deficit can be, like you said, fixed. You know, don't forget LNG. We import LNG largely from Qatar, but U.S. is the largest LNG exporter and has a lot of capacity coming on. India could sign deals with American companies on LNG. And obviously, U.S. as an oil exporter. So those are easy ways to show President Trump that India is, serious about cutting its deficit. And it seems, fortunately for India, that President Trump is fixated on goods trade deficit and is not at all paying attention to the hidden gem of India, which is its services exports. And so that can continue to grow. And so I think India is actually in a unique position where services surplus is quite significant and offsets a significant portion of the trade deficit. So therefore, I think that India is an excellent position to be able to, get some kind of a win. Although even if President Trump doesn't completely remove the tariffs from India, as we've discussed before, India is probably both relatively and absolutely in much better shape than most other economies in the world.
Yeah, absolutely. And let's hope it doesn't start looking towards services. We have enough going on with goods and tariffs and deficits over here. Thank you so much, Matt and Arvind, for weighing in on what's a really important and difficult morning for global markets once again.